Hey guys, in this video I'll be analyzing Starbucks Corporation stock, ticker symbol SBUX. There's a lot of good information in this video, so make sure you stick around until the end to find out if I think Starbucks is a good investment decision at the current prices. Before we jump into the analysis, I wanted to give a quick channel update. Now just this morning, the channel surpassed 150 subscribers, which is crazy because in the last week's video, I was saying the same thing, but about 100 subscribers. This channel is gaining a lot of momentum, and that can be very hard to sustain. So if you guys wouldn't mind giving the video a like or engaging in the discussion in the comments below, I'd really appreciate it because it helps YouTube know that you guys enjoyed the video, and it'll push the videos out to more people. Now I'm considering adding a series to the channel in which each week or two I give an update to my M1 Finance portfolio and answer your questions, so let me guys know if you'd be interested in that. Also, this video is coming your way because my subscribers voted that they wanted to see this one next. There's a poll in the comment below, so if you guys want to have your voice heard and be able to get one of your suggestions in a future poll, make sure to subscribe to the channel. Thanks for everything, guys, and with that, let's jump into my analysis of Starbucks stock. Since the majority of my subscribers are in the United States, I'm assuming that most know of Starbucks, but for those who don't, Starbucks is by far the largest company in the world when it comes to roasting coffee. They were founded in 1971 by 3 college students and a coffee industry expert, Alfred Peet. Now, they're very well known for being the most dominant roaster, manufacturer, and marketer of specialty coffee in the world. The majority of their sales, about 69%, are in the Americas, of which mostly is the United States. But their international presence has grown substantially in the past 10 years, and international sales now make up 8% of their revenue. The remaining 23% of revenue falls under the channel development business units, which basically encapsulate all the sales that happen outside of their retail locations, like large distributors, Walmart, Kroger, etc. In addition to Starbucks brands, Starbucks Corporation also has many other strong brands, including Seattle's Best Coffee, Evolution Fresh, Ethos, Princey, and Teavana, which is a booming high-end iced tea brewer and marketer. Now that we have a good understanding of the company, let's take a good look at their stock. Ticker symbol SBUX is traded out on the NASDAQ exchange and has a current share price of $76. At this price, the company's market cap, or essentially what the entire company is worth, is just short of $90 billion. The company's beta currently sits at 0.72. Now I know that I have not talked about this metric on this channel before, but for some context, a company's beta shows how reactive a stock's price is to changes in the entire market. So if the entire market moves up 1% or down %, Starbucks stock, on average, moves in the same direction, but at only 72% of the magnitude. I like companies to have low betas, because it means that they're less reactive to market movements, and the stock price movement is much more heavily influenced by company news and things that actually matter other than the stock prices of the general market. The stock currently has a PE ratio of above 25, which is much higher than that market is trading at right now. The stock also boasts a dividend yield of slightly above 2%. Now, if you look at the company's one-year chart, you can see the company peaked in July of 2019 at just about $100 per share, and fell all the way down to $56 per share just about a month ago. But another thing you can probably see is the crazy jump in the stock price that they've had over the last month, nearly 35%. I think that with all that information in the back of our head, we should take a good look at the company's financial statements, starting with their income statement. Over the past 10 years, Starbucks has grown super fast. This can be seen by their exploding revenue, for which they had just above $10 billion in revenue in 2010, but in 2019 they surpassed $26 billion. But sometimes a company sacrifices profitability for increased revenue, kind of like what Amazon did up until the last couple of years. However, Starbucks has significantly grown their profitability over this time period as well, and in 2019 reported net income of above $3.5 billion. Now this brings me to one of their most impressive parts about Starbucks' income statement. They're so incredibly profitable. Their current profit margins are just about 14%, which for most companies would be an incredible feat. However, this is actually down from 2018, where they had profit margins of about 18%. So even on their subpar years like 2019, they are able to do things more profitably than most other companies. Starbucks' income statement is incredible and really shows the company's strengths. However, their balance sheet is not quite as strong. Starbucks has added significant amounts of debt in the last couple years. From only having $4 billion in long-term debt on their balance sheet in 2017, they've nearly tripled that in the next 2 years and now report over $11 billion in long-term debt. Furthermore, the company's cash reserves and liquidity are weakening. As of the end of 2019, Starbucks had a current ratio below 1, which means that all the cash that they currently have and expect to collect within the next year, except for new sales, would not be enough to pay off all of their liabilities due in the next year. This isn't the end of the world usually, but right now liquidity is very hard to come by, as many businesses, including the majority of Starbucks stores, are closed for business. At the end of 2019, they also reported that they had $3 billion in cash. Not bad, right? Well, it's a decent amount of cash, but it's a lot lower than the cash position reported just a year prior in 2018, when they had almost $9 billion in cash reserves. Now recently I was watching a video by Andre Zick where he was interviewing a previous hedge fund manager, and it was mentioned that dividends become much more important when the market is struggling than when it's booming. And I 100% agree with that. That's why it's important to assess the strength of a company's dividend to make sure that even in these tough times, they'll still be able to pay that dividend. The company currently has a payout ratio of 50% based on 2019 income, which is a pretty good payout ratio and generally seen as a pretty safe investment. But I think in the current environment, this is a little misleading. 2020 earnings should be hurt massively by this current pandemic, and it's still not known how long many of their locations will be shut down for. If I'm strictly looking at historical numbers, I would definitely be able to say it's a safe dividend. However, as investors, we can't just look at past performance. We need to try to figure out the future, which is actually very hard sometimes, and it's why the returns on investment for investors fluctuate so greatly. With that said, I don't see this dividend as safe at all, and I do expect it to be cut in the near future. So, because of the lack of dividend safety, their current PE ratio of 25, and their current financial position, which we explored in the financial statement analysis, I will not be purchasing this stock right now. I think there are way too many unknowns and uncertainties, and I just wouldn't be comfortable investing money into Starbucks when I know there are much better opportunities out in the market right now. Speaking of better opportunities, I want to know which stock you guys want me to analyze next, so make sure you comment down below. Also, hit the like button and share with your friends if you want to help out the channel, and I will see you guys in the next video.